Wise people, welcome to 11 Reflect, and we'll be discussing a crucial topic, um, the idea of liquidity. All right, so I know that many of you must have heard about this um, one way or the other, but I want to bring it to the table so you can properly understand why liquidity is important in the financial market. All right, so I would just like to define liquidity, but before I define it, I would like to bring to your remembrance that I know that many of you must have seen this kind of thing happen. Maybe you're trying to take price, maybe here, you're trying to sell at the resistance, right? One of those use real examples to explain this. You're trying to sell at the resistance, right? All right, let me label that resistance. Let me label that resistance, right? Or arrow level, right? Resistance level, right? So you're trying to take your trade at the resistance level, this point here, and then the market comes. Let me use a ghost speed. While the market comes, print candles are printed. Market comes, tap your that's not nice. Let me use this. Right. So the market comes maybe to your resistance level, it rejects the first time, and now you're looking to sell at the second touch. You know, this will be a great double bottoms or double tops, and then the market does this, and then sells down. May I ask you a question? Why didn't the market sell at the first touch? Why did it have to take me out before selling? I don't know if you must have seen this kind of thing happen. Or let's assume that the market was in a bullish market, do something like this, right? And then you break out your trend line too, and then you draw your trend line. So you're expecting price to bounce off the trend line and then give you a buy, right? So the market eventually does this, breaks through a trend line, and then continue going up. So you're wondering, why did the market have to do this before buying up? That is what I'm here to explain to you, the concept of liquidity, the concept of liquidity. So let me just remove all of this and then we can continue. I want to just define liquidity, right? There's been so many definitions of liquidity. I was really looking at Google. I was seeing so many funny definitions of liquidity. It said the current ability to be sold or bought without creating a major impact on its exchange rate, right? And all of that. But for us as smart money traders, there's a definition we have for liquidity. And liquidity, I will simply define liquidity as an area where people would like to get involved in the market. So let's say liquidity, all right, liquidity is an area where retail traders get involved, right? Those are the areas where retail traders get involved, right? I'm a smart money trader. I'm not a retail trader. I usually trade the smart money way, right? So you never see me trading double tops and double bottom. That's why I'm bringing this to your knowledge, right? So liquidity is an area where retail traders will likely get involved, and this is what I'm trying to share with you now. I want to show you those places where you like to get involved, and believe me, the institutions and the bigger boys or the bigger traders, they are aware of this, so they use it to our disadvantage. So I want you to just understand where the retail traders will get involved, and this is where the manipulation usually occurs, right? You usually see the market take out your zone of interest and then buy or take out your right. Sorry, I had a little cough, so I had to take a pause. So let's continue. So I would like to introduce to you the areas in which the retail traders would like to get involved in financial markets, and these are the areas where the smart money traders or the banks, the hedge funds, the big traders, they like to take people out, right? The idea is to take retail traders out because they actually make money when you lose money, right? I want to make this in public knowledge. You lose money where when someone in the financial market gains money. That means anytime you make a loss, someone actually profited from that loss. Either a bank, a hedge fund, a fellow trader, or something of that sort, right? So have you ever wondered where you lose your money to? When you make a loss, where does the money go to? It goes to those that we are taking the opposite side of a trade. That means if you are buying, let's assume that you had a buy order or okay, sell order, right? Maybe you took a sell order at this point, right? And price came and did this and then took you out. Basically, price takes you out, you know that you have lost the trade and you've been stopped out. So your money goes to someone that was buying. Maybe someone was buying maybe around here, right? Your money goes to him, right? That's how trading works. You're actually exchanging your money with someone else's money. So what are the kind of, I've explained what liquidity is. It's an area where retail traders will get involved. And what's the relevance of this? The relevance of this is to avoid getting caught in traps in the market. That is the relevance of this, to avoid getting caught by the traps in the market. So we want to avoid getting got by those traps in the market. So the market, you see market do something like this, purposely do this, see the second rejection, and then what is the market doing here? The market is doing what? Inducing you to take your trade here. So when you see this at this level, you most likely want to take your sell at this level. So what the market does is that it has induced you, which is what we call liquidity, an area where retail traders will get involved. So they are creating liquidity at this point, trying to get you interested in this market. And what does price do after that? Price does what? Takes you out. So this information is to help you to avoid getting caught by this kind of trades, right? So I will teach you the kinds of liquidity and the possible ways to avoid getting caught in this trap, right? So let us go. Follow me closely, right? So let's continue. Right. So before I continue, if you have not subscribed to my Telegram channel, just do well to subscribe with the link in the description, and so you get more information about us, because I can't really post on YouTube as often as I want, but I can't post a text, I can't post an image on YouTube. It's only videos. Videos take me a lot of time to create, right? So if you have not joined my Telegram channel, please join with the link in the description, all right? And if you want to get involved in my mentorship program, do well to do that. So let's go straight to the types of liquidity we have. So we have basically 4 kinds of liquidity, 4 kinds, right, of liquidity, right? So we have 4 kinds of liquidity, right? And I'll be listing them out. So we have the first one, which is called the external, right? So the 4 kinds of liquidity. We have the external, the internal, we have what we call the dynamic, right? And then we have what we call the static, right? So they're basically the opposite of each other. We have internal, external, dynamic, and then what's static, right? So let us start with the first one. So external liquidity is simply the liquidity or the area that's at the range high or range low. That means the market is giving you a bullish structure, right? You know, as when the market gives you a bullish structure, when you're taking out your top range, this is your top range. The top range is obviously the last higher low, and this is your top range, and this is your this is your bottom range. So this in a buy market, between the last higher high and your last higher low is your top range and your bottom range. So this is your top range and your bottom range. So your external liquidity is simply this point here and where here below the range, and this is what we call the external liquidity below this range. So that's your external liquidity at the top and at the bottom of your range, right? So we can just type that S liquidity, right? External liquidity, right? So this external liquidity, the top range. So if I calculate that, I break it down. That was called the lower range. So top range, lower range, external liquidity. Then for a bearish scenario, when the market was selling down, right? So we have market selling down, have a bearish market doing something like this, right? The market does this. So you can see the same thing. So between your top range and your bottom range is what we call your external liquidity, right? Very simple. And that is where you should put your stop loss. If you're buying the market, your stop loss should be where at the external liquidity region. That means if you're in a buy trade, your stop loss should always be at the higher low, right? If you said the stop loss should be was above where the last lower high. So that is what we call top range, bottom range, and then external was liquidity, right? So now we have gotten that for external liquidity. So now let us talk about the internal liquidity. So I'll be deleting this, right? I'll be deleting this. Give me a moment. Right, so we have gotten what an external liquidity is. So we'll get the internal liquidity. Now, for internal liquidity, when the market is buying, excuse me, no, higher high, higher low, higher high. So I told you that the top range is where the top range is at this point here, the top range, and then your bottom range is at this point here, right? So yeah, this is your bottom range, right? So we now have so we have our external liquidity to be up here and then. Now for internal simply means any region that is in between this zone, right? The market comes here and does something like this. Maybe market does this and creates some kind of what equal lows at this point or double bottom here. This becomes internal liquidity. Why? Because it is inside the trading range. Your external liquidity is outside the trading range, while the internal is inside your trading range. So when the market does this, this is best to be avoided. That means if you see the market doing this, best avoid it. When the market is going to do this and take you out, right? Before tapping maybe the other block or demand zone and then go higher, right? So you should always avoid internal liquidity. This is internal liquidity. This forming, right? So when I feel that trade double tops, once you are done, like you would have said, okay, we have tried to sell at this point here. So market took you out, and then see went and took these people out, and then see bought up, right? I told you that if you're in the buy market, your stop loss should be where at the bottom of the external liquidity, right? So you have external, internal. So yeah, can you see it? Can you see this? Right. So that is it about internal liquidity. Now for dynamic is simply your trend line, right? Dynamic could be internal and it could be external. So what do I mean? When the market is buying, right, in the kind of trend line format, right, in the kind of trend line, this is what you call the dynamic liquidity, right? So this region here is your internal dynamic liquidity. That means the market is creating some kind of trend line, right? 1, 2, 3. So this is a dynamic liquidity because these are it is dynamic, meaning it's moving. Dynamic simply means moving, right? So for the liquidity to be moving, people want to get involved. I told you that liquidity is an area where a trader want to get involved. That means if the trader see a bounce and a second bounce on the trend line, he would want to get involved here as the next bounce of the trend, and that makes it a dynamic liquidity because it's moving. It's not at one spot like the previous one that we had, right? So it's moving upwards or downwards, right? If it's a bearish market, you know how it is. Bearish market, you know. So if it's in the bearish market, it's simply moving as well. So you have the bounces occurring as the trend line, right? So you have that for your dynamic liquidity. All right. Excuse me. I'm having a kind of cough. All right. So we now have the dynamic, and the final one, which is called the static liquidity. The final one is the static liquidity, right? So let me undo this. Static, as the word implies, simply means at its fixed point. That means your double tops and your double bottoms are what we call a static liquidity, right? And static could be dynamic or it could be internal. It could be external or internal. So this is your static liquidity, right? You just place that you can find the market rejected or self rally. So you see if it's a buy scenario, you know, market does something like this, you know, this becomes what dynamic liquidity, right? I mean your static liquidity, this point here, right? So double bottoms are the areas where the markets like to induce people to get involved in the market. So personally, I don't treat double tops, I don't treat double bottoms. This is what we call the internal, the static liquidity, the static liquidity. These are the static liquidity. At one point, it doesn't move, all right? So if you may watch this video 1 or 2 times to really grasp what I'm teaching you. So you have 1 bounce, 2 bounce, this is what we call the static liquidity, and this is your static liquidity, right? So now we have identified the 4 different kinds of liquidity. Now I want to show you the when a dynamic liquidity is actually internal. So let's assume that we have a buy market a high, a low, a high, a low, a high, and then a low, right? So now I told you that to establish a trading range, you mark where the last higher high and the last higher low. So this becomes a trading range. So from here to here is a trading range. Now, inside this trading range, you can have the market doing this, something like this, creating a kind of trend line here. So now this is what we call a dynamic internal liquidity. Why? Because it is inside the trading range. This is your top range and your bottom range. So this becomes internal because it is inside your trading range. Inside your trading range, right? You can say trend line here. This is what we call a dynamic internal liquidity, right? So I've explained that. Now for a static internal liquidity, that means the market something like this. You see the market do this, something like this, right? What has it done here? It has created liquidity inside the trading range. Look at this. You can see this. You can see that it has even created something like a resistance here. This is what we call the internal static liquidity because it's not moving and it's inside the trading range. So you can see markets will obviously do this, take out stops and then take out stops. So you should always avoid internal liquidity, right? Always avoid this kind of setup, right? Avoid this kind of setup. Avoid double tops, avoid double bottoms that are inside the trading range, please. So how would I play this, right? How would I play this? For to play this, how would I play it? If I want to buy this market, right? If I want to buy this market, right? I want to buy this market, right? Assume I want to buy this market, okay? So what do I do? If I saw this thing playing out, I wouldn't take a trade with this. What should I wait for? Since it's a bullish market, right? I'm looking for a buy. I would wait for the market to do something like this, maybe tap there, and then, sorry, wait for the market to do this, to tap here. This is a bearish market. Maybe tap another block or something here. I want to see the markets give a break on structure. So if you have not watched my video on market structure, please go and watch it. So I want to see, since we are in a bullish market, I want to buy in a bullish market. So I want to see the market do this, take out the last high, lower high, then give me what? A retest, and then I take my buy where I will clear all this liquidity. So I usually target liquidity for clearance. So as the market doing this, I will wait for a BOS. I will give about until I see the market give a BOS, right? Markets may even reject here again, give another rejection at this point here. For me, I would like to see the market give a break on structure that is clearing the last lower high, give me a retest, maybe at the other block or something here, a demand zone or whatever. At this point, I take my buy. I am clearing all this liquidity, and where am I targeting? I'm targeting where the external liquidity, right? So this is a very simple concept. Always avoid internal liquidity. Avoid double tops, avoid double bottoms that are counter trend. So for you to properly understand liquidity, you must go and watch my previous video on what market structure. So this is the summary of this. This is the summary of this, the summary of this, right? This is the summary of this. So I would like you guys to rewatch this video if you don't understand this. Please subscribe to my YouTube channel if you haven't. If you haven't, subscribe to my Telegram channel if you haven't. And I wish you the best. This is the end of this video, right? If you want to learn more about this, you can join my mentorship program or watch the subsequent videos that will come in after this, right? This is also easy to identify these areas. If you watch this video, if it's new to you, and it should be properly understood. So for you to properly understand this, always apply market structure. So in the buy market, you should buy. In the sell market, you should sell it. I just give one example for a sell scenario. As the market was selling, lower high, lower low, lower high, lower low, right? And market starts giving some kind of bullish structure, right? What am I waiting for? I'm waiting for the market to give me what? A break on structure. It's taking out this last low, and then I enter at a retest, and I take price down. So I'm looking to sell this market. Why? I'm going to sell the market because it's a bearish market. Why is this bearish market? Because why? I can establish my trading range, right? I can see my last low here, lower high here, and my last lower low here. Yeah. So I'm looking out for sell ideas inside there. So I'm looking out for a BOS to the downside, and I click on it, clear all this liquidity. So don't set trend lines that are against the trend. Don't take trend lines without a BOS that is in the your direction of interest, right? So that is it about internal liquidity. So have a wonderful day. Cheers and God bless. Subscribe and share this video.